Thanks so much for joining us, everybody. I am really excited about today because today we get to talk to Chris Shockowitz with tax strategies, about tax strategies, and he is with deferredtax.com. And a lot of people think it's really geeky to talk about taxes, but I love this subject because it's literally what made me be able to leave my job. So I was already doing all this real estate stuff. I was doing it on the side while I had another full-time 9 to 5 kind of job. And when I finally talked to tax strategists like Chris, I found out I was working for free. Basically, by simply taking advantage of some of the tax strategies we'll be discussing today, I was able to leave my job because the tax savings we were going to get by writing off my husband's active work with my passive losses through real estate replaced my entire income. So then I was able to scale and go faster. So that's why I geek out about this kind of stuff. But Chris's firm specializes in reducing, deferring, or in some cases, completely eliminating personal income tax, business income taxes, and capital gains taxes. So we're going to dive into this. And I could talk about this for weeks and weeks because Chris literally has 40 different strategies. And obviously, we're not going to have time to dig into all of that today. So we have about an hour. So we're going to talk for about 35, 40 minutes about various things. And then we'll turn it over to all of you guys, our viewers, to ask us questions. And Chris will field all of those. And so if you have questions as we go along, please jot them down and then hit us with those at the Q&A section at the end of this. But Chris, can you just start us off with a little bit of an introduction? And, this is a very unique and valuable niche. So please tell us how you got into this business.
Yeah, it was pretty interesting. So I had worked at Intel for a long time. I was a director of application development. I also was a real estate investor. My largest purchase was 12.5 million. Actually, my largest exit, was 12.5 million. And it was all my money. So I did my own loans, and I wish I actually found the legacy team before. So I actually partnered with people instead of doing it all on my own. But basically, I didn't like the way things were going at work. And so I was really pissed off one day, and I looked at my finances and said, hey, I can afford to retire. So I did. And I got extremely bored. So long story short, I had a property in Santa Clara, California I bought for like $575K. And I decided to sell it. And it was a primary residence. But eventually, we rented it out. We moved out of the area. We decided we never wanted to go back there. So I was interviewing realtors. And one of them said, hey, I know this guy who can defer the taxes on the sale of your property. And I'm just like, what? I would know about this, but I was just too curious. So I met with the person, and that person's now my business partner. Long story short, I made, Carl. So about 1.23 million off of the sale because I bought it for 575. I sold it for 1.7. That money all went into a trust, and I have yet to pay any taxes on it. And this was in 2018. It's also generated about a $70,000 a year income. So essentially, I paid no tax, and I was using essentially my money plus the money owed in taxes to basically grow my wealth and generate income. So in the process of working with this person, we just kind of hit it off, and he was saying, hey, there's stuff about my business that isn't taking off. I don't know why. And I had a lot of business experience. So he hired me as a consultant, and then we just hit it off, and I became a partner, or we became partners. So that was about almost 5 years ago. And so ever since then, I've been just, like you were saying, geeking out on the strategies and basically growing our business.
I love the fact that, the IRS code is huge, right? And only like 1% of it is about how to pay taxes, and the other 99% is about how not to pay taxes. Exactly. So it takes someone like you that's willing to geek out to really figure out all of that, because I'm not going to read that thing.
Yeah.
But okay. Well, my audience is primarily your business owners, real estate investors, or high income earners like physicians and attorneys. So tell me just in general scopes how you can help individuals like that save on taxes.
Yeah, well, at the end of the day, it comes down to active income, passive income, or capital gains income, whatever the source is, right? And we basically have strategies for each one. So what I begin is, if there was no tax code, what would you like to do with the money? And then what I do is I put together the strategy to do that. So, like doctors, for example, they are probably the most negatively impacted by the tax code, because they'll tend to make high salaries, but they'll work for a hospital or for a group and they have no write-offs. And they're too busy being a doctor to be an active, real estate professional, right? So they pay the maximum in taxes. So we have ways to basically cut that tax bill by up to 50%.
Oh, wow.
Or active income. Capital gains income, we have multiple different ways, actually 17 different ways we can reduce, defer, or eliminate the capital gains for real estate. If you're in a business space, there's multiple different ways to reduce the taxable income for the business, as well as, if you sell the business, pay no tax on the sale. So we have solutions for all of those scenarios.
Good. Well, let me hit you with some of those scenarios then.
Yeah.
I own a number of businesses myself, right? So in addition to the real estate, a few of those I would like to sell within the next 5 years, give or take, right?
Yeah.
Now, I don't plan on using that money to buy more businesses, at least not any that I actively manage, because I've got enough to do, and that's why I want to sell them. So I don't know what I plan to do with the money after I sell, but I do want to make it tax efficient. So like, what are some potential strategies for someone like me?
Yeah, so if I'm catching you before selling the real estate, if you're basically about in the LOI phase.
Yeah, not real estate in this case, other businesses. So
sorry, I meant to say businesses. If you're basically looking to sell a business and you're in the LOI phase, or maybe a little after that, right? Letter of intent. If you're selling the business, you know that, right? But
yeah, just for our viewers. Yep.
Yeah, no worries. So we have the ability to essentially sell the business into a trust, pay no tax, and then you can reinvest that money any way you want. The tax bill is essentially deferred for as long as you want to defer it. This could be your lifetime, your spouse, your children, off into the future. And essentially that investment account also grows tax deferred. So if you basically wanted to go and invest, you can invest within this trust structure and essentially pay no taxes on the growth of your investment. And if you're going to take the money out, all you're going to do is invest it. We'll just invest it from inside the trust instead of outside and let it grow tax deferred. And it basically can pay you an income stream, and it could also pay you upon request. So, if you're saying, hey, I want to hold this money and turn it into a retirement fund, we have a strategy for that. If you want to put it into a vulture fund to go jump on buying another business, you can do that. You want to hold it for 3 years and then turn around and buy something later and earn income in the meantime, we can do that. You want to basically do a legacy, wealth growth kind of a strategy, we have multiple ways to do that. So depending on what you want to accomplish with the money, we can basically set up that strategy. And the cool thing with this one is you can change your mind along the way. So if you're younger and you want to, basically be a serial entrepreneur and go invest in more businesses, you can do that. If you're reaching a point like you're saying, hey, I just want this off to the side. Maybe I want to use it for hard money lending. Maybe I want to use it to invest in other real estate. Could be syndications, could be physical properties. Maybe I want to, just basically keep it in stocks, bonds, and insurance products and just let it grow over time. All those are options, and it just comes down to what your investment tolerance is and what your appetite is to figure out, what we would do. And essentially the idea is that the only business purpose of this trust is to invest on your behalf. So if you're the seller, you become a note holder. As a note holder, you can't have direct access or control to the money. However, through your investment advisor, myself, we can basically go do anything you want to do.
I love it. I love anything with flexibility because I do change my mind a lot. That's why I ended up with so many businesses and why I want to sell some, right? So
yeah, and you only pay tax if you take personal possession of the cash.
Okay. So as long as it's a trust expense, for example, it can pay those expenses on your behalf too.
Not an expense, an investment.
Okay. Right. Okay. I'm thinking about expensing off some of your living stuff. All right, we won't go down that rabbit hole.
Right.
But I love that. Okay. So now, that that benefits a lot of our business owners who are listening.
Oh,
Real
I forgot
estate.
to mention one other thing on the business. If it's after the fact and you already sold the business, we have a couple of different ways we can deal with that situation as well.
Okay, yeah, I was gonna get to some of that as well.
Yeah.
But we can jump to that now since we're on it actually. So okay, so let's say I met you, Chris, after I'd already sold this. Let's say it's within the same tax year, or maybe it was 2 years ago. I'm sure those are different strategies.
Yeah, if it's within 6 months, there's something called the qualified opportunity zone, which becomes an option. What that does is immediately defers the tax bill. Depending on which state you're in, like California, New Jersey, and Hawaii, you would have to pay the state tax. Every other state, you don't. Essentially, it would defer the tax bill. And then once that tax bill is deferred, essentially, it can be put into an investment that would create anywhere. It would basically create an income stream, which I can't go into on this particular live stream in terms of how much it is. And then on the back end, it would essentially grow, typically a 2x or more. It's a 10-year hold, but essentially we could take just the capital gain. So if you take your basis in whatever you've sold, and then your capital gain, we just invest the capital gain, and then the basis goes into your pocket tax-free.
Oh, wow. Not bad, not bad. Okay, so what if it was you sold the business a year or two ago? Can you do anything, or is it too late at that point? They should have just gone
Well, if
back
it's the same business year or same calendar year,
okay,
we have the ability to cut your tax bill by up to 50% through an investment strategy. That investment strategy is essentially one of them. There's multiple different ways to do it, just in the interest of time. One of them, you're essentially doing a real estate investment with the money you would have paid in taxes. And then that essentially has a preferred return. And at the end, you also get your original investment back plus any appreciation. And it provides you a 2.5 to 1 tax deduction. For every dollar you put in, you get $2.5 deduction.
Nice.
Pretty powerful tool.
And that can be used, that's not a passive loss, so that can even
That's
be used
any income, active, passive, or capital gain.
Sweet.
Yeah.
Okay. Like that. Okay, let's talk about
one last thing is there's no more available this year, but they're depending on what's the availability of it. There is a solar solution that can go back up to 3 years and reduce your tax bill.
Okay, and so they have certain number of allocations for that.
Yeah.
Each year. Okay.
Yeah.
So
they're just filled up.
So somebody asked, so all proceeds go into the trust? That was a question that came in.
Yeah, in the trust solution, the idea is when you're selling, right, all of the cash would go into the trust. And then from there, you can basically go invest into whatever you want to invest in.
Okay, so the trust is doing the investing. Okay,
yeah.
Makes sense. Okay. All right, so real estate. So if there's somebody else out there like me that has a bunch of little properties and maybe want to go into something big, so like right now I have 2 single family homes I'd kind of like to get rid of and 2 smaller apartment complexes. I'd love to sell them all and get one bigger thing.
Yeah.
And I know there's some 1031 exchanges you can do, a reverse 1031 exchange, but both of those can be difficult. So maybe you have another strategy. But first, can you tell our investors what a 1031 exchange is, what a reverse 1031 exchange is, and then maybe go into other options if you either fail when you're trying to do it, or if you just don't want the headache of doing that in the first place.
Yeah, that sounds good. So the beauty of a 1031 exchange is you're basically selling your relinquished property, and that is, and at the close of escrow is day 1. You have 45 days to identify replacement properties, 180 days to close. If your intention is to go out and buy another piece of real estate, great tool for that, deferring the tax bill. The downside to it is you're maintaining the same depreciation schedule of the relinquished property. So if I'm selling a property I bought for $400K, it's now worth $1 million. And I've got, let's say it's a house and it's 27.5-year depreciation schedule. I held it for 10 years. I have 17.5 years left on that original $400K purchase. That carries over in the 1031 exchange. So even though you're buying a new property of equal or greater value, so if you bought a new one for $1 million, you're still only getting the same depreciation of what you had on the original property, because that carries forward.
I didn't realize that.
That's the downside of the 1031 exchange. The upside is you're not paying the tax on the 600K gain in this particular case. And a reverse exchange is just the opposite. You buy the replacement property first, you go in with your cash and get your own financing, and essentially that replacement property is now sitting essentially within an LLC that's managed by an exchange accommodator. And then you're going and selling the other properties and taking that cash to basically net out your debt against the original property. The problem with all of these is the 180-day window and the 45-day window. You got 45 to identify, 180 to close. So in the reverse exchange, you've already bought the relinquished property, so your identification's done. The problem is, can you actually sell in time, right? So typically what I coach people in the reverse exchanges is have your deals lined up before you, and if you have to buy the one property because of just timing, do it, but make sure that those other ones are solid, on closing, right? Otherwise you're going to be stuck with multiple mortgages.
Okay.
And it goes beyond that 180-day window for the reverse exchange and you sell, you can't use the money on that property you just purchased because you've already passed 180 days. There's also something called an improvement exchange where I can take the extra money left over in a 1031 exchange. And for my new property that I bought, I can use that extra cash to improve that property. But again, all the improvements have to be done in that 180-day window.
Wow. So that counts into it too. It's not just getting the property. So you've gotten away from the 45-day identification period, which is probably the biggest stress, but then you still have the 180-day close either way. So in my case, I'd have to get 2 houses sold and 2 apartment complexes sold in 180 days.
Right.
It's all single family homes. That's probably doable. The apartment complexes, they usually have a longer due diligence and finance due diligence period. So that could be pushing it. Okay.
Yeah.
So
and other people sometimes will start messing with you because they know you're under the gun.
Yes, because you have to disclose it. Yeah,
right.
You do. So they could try to use that to talk you down further before close, or say, yeah, hey, we found this
concessions or whatever.
So
so I've been there, done that. So what you can do is you can actually set up alternative exits to the 1031 exchange. So there's multiple different ways to do this, but in the case you were specifically talking about, I've got 4 separate properties. Like I had one guy that had 50 SFR, single family residences. No way you're going to line all those up, right? So what they did is over about a year is they were selling them, and we used that same trust structure I talked about before, where the trust just aggregated everything. So the taxes, the capital gains taxes were deferred. The cash from each one of the sales essentially starts with the 1031 exchange. We let the 1031 exchange fail at day 45, day 46, instead of the money going to your bank account, it goes into the trust bank account. So at that point, you can start aggregating the funds, and then you can go out of the trust to go buy that other property. And then you're not worried about essentially the 45-day or the 180-day, because that trust acts like an intermediary to, allow you to park the cash there, create an income off of that cash. So we invest in it, doesn't just sit there and do nothing. And then you can take that lump sum out and go buy. And you don't pay tax on the whole process.
Okay. And as far as you having money, so now the trust kind of owns everything, if I'm understanding it right.
Yeah.
Are you selling it to the trust? So the trust then pays you basically on a loan for it? Is that how you as an individual?
Yeah, let's talk it through. So essentially the way that it works, if I use an analogy for just owner financing. So let's say I came to you, Maria, for one of those houses and say, hey, I really like this house. I'd like to buy it for $1 million. However, I don't have the cash. Would you carry a loan for me? If you say yes, I take possession of the property. You take a note that says, I promise to pay you X amount per year and maybe a balloon payment in 10 years, whatever the terms are for the note. Well, that is a part of the tax code called IRC 453. It's installment sale tax law. And it's the reason why a 1031 exchange works. Because essentially what happened was you did not take possession or control of the money. Therefore, you did not pay the tax. That's a fundamental part of the tax code that was written back in, 1913 or 1914. So It's just foundational to the tax code. If you don't take possession and control, you don't pay the tax. So because you took a note instead of cash, you're not paying the tax bill. Now, the problem with this is that if I'm holding, if I've got a note out to you and 2 years from now, the interest rates drop 2%, I can cash you out and then you'll still have to pay the tax. So how do we, fix that problem? Well, we basically put a trustee in the middle of the transaction. So the seller sells to the trust sells to the buyer. The buyer has to get their own financing and bring cash to close as normal, but that money drops into a custodial account and you as the seller are taking back a note. So now you took a note, you didn't take possession or control of the money, you're not paying the tax. The trust bought it and sold it for the same price, so it pays no tax. That money is now sitting within the trust, which this particular trust is a structure that was invented in 1917. So the tax code was created in 1913. 1917, they're already trying to figure out how not to pay taxes, right? Even though it was a 1% tax. But essentially, this structure, its only business purpose is to invest on your behalf. So this is your money that you hold a note against. So you've got a demand note, right? Now the trust can then make investments and can pay you an income against the note because the note has an interest rate. So it's not a loan scenario, it's actually a purchase scenario. So it's similar to when you buy a business. If I buy an LLC from you, I'm giving you a certain amount of cash, and maybe I'm also carrying back payments over time, which are installment payments. Well, in this case, it's purchased 100% no cash up front. You get the note, all the money is going into the trust, and then you can go reinvest it. And then if you want to go invest in another business, or if you want to basically buy real estate or buy crypto or do hard money lending through a business, whatever, you can take the cash from the trust, put it into an LLC. That LLC is a partnership with the trust, and you can now invest that money because you would be the general partner and the trust would be a limited partner. It's just for providing the cash.
Got it.
So what this allows you is to go invest in anything. So from a real estate perspective, that's the suggested method for essentially dealing with the scenario that you're in. If you had properties that were bigger properties, and let's say you had no debt on them, we also have the ability to essentially sell those properties individually, go into a 1031 exchange, and then instead of going into a trust solution, we use a special type of DST, or Delaware Statutory Trust, which it would actually 30 days after you make your investment, you get 85% of your cash back tax-free.
Wow. Okay, you're making my head spin.
Yeah, there's multiple different solutions, essentially, is the short answer.
Yeah, okay. So what I'm gathering is if one's not a good fit, you're going to find another.
Exactly. It goes back to that whole thing, based on what you want to do. In your scenario, you said, I'm not exactly sure what I want to do. Well, right. I'd probably lean toward the trust because it's so flexible. Because once you take the cash, you take the cash, right?
Right, yeah.
And you could always decide to take cash later if you take the trust.
Yeah, so then if you wanted to buy another business or something, or a property or whatever, even 2 years down the road, you still have that option if it's inside the trust structure. So,
right.
Okay. So let's say somebody sold a business or a piece of real estate or something like a year ago, and they're receiving large installment payments that are coming in like this year. Is there anything that can be done about that? So they didn't set up a trust, they didn't structure anything back then, and now they're getting these installments, because that's very common when you sell a business, is that you take part of it, if not holding the whole loan, you might be getting large installment payments. Yeah. So anything that can be done about that?
Yeah. So the whole thing is, as long as the installment is not past due. So if it was due on April 15th, let's say, just to pick a date.
Okay.
We can actually set up that exact same trust structure so the installment goes to the trust instead of you. Completely.
Oh, even after you've sold, even though you didn't sell it within the trust, you can do that after the fact.
Yeah, with the installment payments, not the original. So let's say I sold a $10 million business. I got $3 million upfront, and then I'm getting $2 million a year payments. Well, we can defer those $2 million a year payments, but because we didn't do the trust before the original payment, we can't do much about that. If it's in this tax year, we can cut the tax in half, but we can't do much about the original payment if we're not getting the trust, set up in advance.
What if the business just has a large tax bill due each year? Can they reduce that
Yep.
with or without a trust?
Well, you wouldn't use the trust for that scenario. You would use some other options.
Okay.
So, the common things to look at, and it depends on the sophistication and how much money we're talking about, but the sophistication of the owner. Because not every solution is the right solution, but there's the solutions around just basically looking at retirement planning. So you can basically, instead of paying the tax bill, you can put that into your retirement structures. There's the simple things like a SEP, or you can do a cash balance plan. We also have some plans that allow you to essentially skew a significant amount of the cash to you versus the employees. So you can put in place a employee participation plan, 401k, and then it's called the defined benefits plan. And the combination of these, you would give a certain percentage to the employees, which a certain size business in some states you have to do anyway. But then the remainder would all be able to go to you or whoever the owners are, split up between the owners. And you can get it to like 80-20, where it's 80% going to the owners and 20% to the employees, if that's what you want to do. You want to do it the other way around, we can do it the other way around. It just depends on your goals, right? But and the older you are, the bigger that number can be. So like if you're 60 years old and saying I have no retirement set aside and my company's making $1 million a year, well, we can actually take that $1 million a year and put it into your retirement plan.
Oh, wow. I just spoke to someone literally this morning. We had breakfast and he was in that exact situation.
Oh, yeah.
So I'm going to send him the recording of this video because I didn't have time to share with him. But yeah, that's exactly what it was. He says, I'm just about to turn 50. He was about to turn 50. And he said, and I'm getting married again. And I make a lot of money, but I have nothing set aside for retirement. Yeah. He owns a business that does that. So
and that's common.
That.
A lot of people, their retirement is the business, right? So that's when they're looking to sell it, and you don't want to give 30 to 50% away in the tax bill.
Well, a lot of them get a bad reality check when they find out their business isn't worth what they thought it was, because they didn't structure right for selling, which can take years to structure. So then they either have to postpone retirement and restructure, or they have to take a major hit. So that's not always the wisest retirement plan. Oh, agreed.
Exactly. So in addition, there's essentially, you can look at the insurance for the business, and there's a way to do self-insurance. And again, depends on the size of the business and the sophistication of the person and what type of business that they're in. But you can actually take, literally millions of dollars and put them into self-insurance. And then you're essentially, if you're not using the insurance, you get to keep the millions of dollars. So instead of giving a premium to a company that then, it's gone, you can basically self-insure. And set up the insurance policy structure where you've got additional protection above and beyond what you're investing. But at the end of the day, a small percentage of that is going to the insurance company, and the majority of it's coming back to you. So your insurance money is not disappearing, right?
I like it.
And then essentially there's a number of other things in terms of just looking at, there's smaller things like if you hire somebody who hasn't been employed for a while, you can get up to a $9,600 credit for each one you hire, for example.
Oh, wow.
And that's not just like an ex-con, it's also a stay-at-home mother, So it's anybody who's basically new to the workforce. So there's a bunch of small things like that.
Child like what I've got, he has a hard time getting employed. So that's a nice benefit for someone, that wants to hire a special needs person. Hint, hint, hint. Anybody listening? Please.
Right.
Okay. Well, I could ask you. Yeah, I could ask you 1,000 more questions, but I also see we have a lot of questions from our viewers. So I'm just going to finish up with a couple more, and then I'm going to let you start answering some questions from our viewers here. But in all that you've done, is there an example of someone you've helped that you're particularly proud of, like something that you really pulled someone's butt out of the fire, or just a particular big win?
Yeah, there's two examples. There's this one guy, older guy, 80 years old. Had bought these investment properties with someone who essentially bought wrecked homes and spent the money like it was not a wrecked home. So, he was getting this income, and all of a sudden it stopped, and he had all of these properties that were just not really up to par. And so he had taken his big investment property, sold it, went into these, it was about 100 different single family residences. And the whole model that he was sold essentially was he's going to get a 7% return. Well, then he finds out that, after about a year, the payments stop and he's got nowhere near the value, right? Plus, he had been doing 1031 exchanges his whole life. So he had no clue what the basis was of this. So if he was just going to exit, he would have got slaughtered in taxes. So even the little bit of money he would have got back would have been almost 100% taxable, right? So what we did is we basically set up some Delaware statutory trusts that would pay him income. So he was able to sell these different properties, and we pulled them together kind of in tranches. And we did, at the time in that area, stuff was selling really well. So we had essentially, 4 different groups where we got 20 to 30 properties sold, and then we put it all into one bucket that would then buy something that paid him a 5% income. And he didn't have to go figure out all the taxes, didn't have to pay the taxes on the money he had left, which was still millions, but it was like 2 million instead of 5 million. So he had this huge loss where he would have lost all the cash to taxes. Instead, he had an income stream and didn't have to pay the tax bill.
That sounds like a win. Okay.
Yeah.
And you said you had a second example?
Yeah, the other one is my business partner. There was this couple that lived in Aptos, and they had a little 2-bedroom, 2-bath home, but it was on the beach. That was probably worth a couple $1 million, but they only had they were retired and they had about a $6,000 a month income. And in California, that's not a lot.
No.
So, and their friends had moved to Georgia. So they wanted to sell their house and move to Georgia by their friends, and see if they could take money from the house. Their realtor did a proposal to them, which was completely wrong, and they would have lost almost all the money in taxes. So we were kind of brought into it and intervened, and we basically replaced the realtor because they were trying to basically sell the property for below their asking price, which we knew the market wasn't like that. So long story short, they were selling it for 2.2 million. Instead, it sold for almost 3.7 in a bidding war. Yeah. So this guy is trying to sell it for 2.1. Instead, they got 3.7. Number one. Number two, they were able to take money out of the house, which was their basis, about $800K, go buy the property in Georgia, go move there, take a little bit of extra cash and fix up the house for sale. And then when they sold the house, we were able to go invest that remaining money. We put it into one of the trusts that I talked about. So they paid no tax on it. So they're now, instead of $6,000 a month, they're making $20,000 a month, plus they have a paid for house in Georgia.
Wow. Take that all day long.
The other plan would have basically left them with nothing.
Wow. Can you imagine selling a valuable house like that and getting nothing?
Yeah.
So that stinks. All right. Well, with that, we'll turn it over to some questions from our viewers. We'll go ahead and pop those up on the screen here. So here's one. What are the details of fees for the deferred trust? What are annual fees? Are there annual filing fees? Can you give an example of fee structure if sold through the trust and now have a 1 million gain, and or if I had 5 million gain?
Yeah. So this is probably a more one-on-one conversation, but the trust at a high level, the attorneys, it's 1.5% to set it up. So it's very inexpensive. The costs associated with operating and investing, it depends on what you're investing in, what the fees are associated with it. But essentially, at a baseline, the trustees about 75 basis points and the advisors about 75 basis points. So another 1.5% per year. Can be less, bigger numbers, lesser fees, right? Lesser percentages. But use that as a ballpark. It's a good starting point.
Okay, great. Let's see what else we've got. So Lindsay says, so let's go back. Did you say you can sell houses, seller financing out of the trust?
No, I was using the seller financing as an example. So the trust doesn't hold the real estate. So you're actually, whatever the asset is being sold. So in the case of the house, I was using it as an example that owner financing was an example of basically how the trust works. The trust works very similarly. It's just instead of you selling to an individual, you're selling to the trust and you're taking a note back. So now your money is sitting within a trust. The buyer had to bring their own cash. That cash drops into a custodial account like a Fidelity or Schwab. And then from there, we basically go execute an investment plan to create the result that you're looking for. Like that couple I talked about, they were looking at retirement income sustainable for the next 30 years. So, we were able to generate 20K income for the next 30 years, 20K a month.
Got it. Okay. Let's see. Francisco, I have a low salary and make the majority of my income through distributions from my businesses. That's a smart way to go. Are there tax strategies to pay less tax on income based on income based on this?
Okay. So yeah, so if you're essentially S corp and you're doing owner distributions so that you're not paying payroll taxes on the income, smart way to go. You still got to pay tax on the owner distributions. Yeah, that's where we have solutions like that real estate one I talked about that could cut that taxable income by up to 50%. It basically starts to work around a 500K total income. That's kind of the sweet spot. It can work at 400 if you've got state taxes, but typically anywhere in the country would work around 500K.
Got it. Okay. Okay, I cannot pronounce that.
Yeah, I don't know what that means either.
Tina, can you? I think maybe something happened there in the typing, but we're talking about trustee of a trust.
Yeah, so the trustee is there's a company we work with. That's all they do is trust. The trustee work for these types of trusts. They pay a bond to the attorney company to become a trustee. The trustee is essentially vetted quite heavily because we don't want a Bernie Madoff type scenario. In addition, the way that it's set up with checks and balances, the trustee can't take out money without me approving it. I can't take out money without them approving it. And then any request,
checks and balances.
Yeah, and any request, it's validated against the note holder, right? Okay. So it's how we kind of make a triangle there. So it's even more secure than if it's just in a trust account. The other thing is the trust company has been around for 30 years. They've been audited 30 times, never paid a penny to the IRS or any state agency, and they provide free audit defense for their trust because they never want to lose.
Sweet. Yeah, I think I'm deciphering that as good candidates for trustee of the trust.
Yeah,
I think is what that was supposed to be, but I think that's what you answered there.
Yeah, it can't be you. It can't be an employee. It has to be arm's length.
And can't be a family member, I assume.
Right. And it must be somebody who's basically paid the bond to the insurance company or to the attorneys that set up the trust. So they have to be vetted through the attorneys to become a trustee.
Okay. So what about somebody who's like you mentioned a doctor, right? So let's say they're earning over $1 million, and it's strictly W-2. So you talked about. I'm assuming similar would like a regular business owner, but well, no. If they're working for like a hospital, they're not. They can't do the insurance thing that you talked about, and they can't do a retirement plan.
They can do retirement savings up to a certain amount.
Retirement savings, okay, right. Yeah.
But
now retirement plan for the employees, like we talked about with the business owner.
Right, you can't do that. Because they don't have an LLC, right, or a business. However, that's where we use the real estate transaction I was talking about. There's actually multiple ways to do it. There's oil and gas solutions, there's mining companies, and there's this real estate company where essentially you're using your tax dollars up to 50% of your taxable income. So if you're a doctor making $1 million, you're looking for a $500,000 deduction, half of your income. You can basically take a 2.5 to 1 ratio. So a $200,000 investment basically gets you a $500,000 tax deduction. $200,000 is basis in real estate that pays you a preferred return for 5 years. Year 6 it sells, you get your original money back plus any appreciation.
Okay.
As well as the income along the way.
Got it. Okay, very good. Now, what about a real estate investor that's like flipping houses or a developer? They don't hold them long enough to really get in the capital gains category, so they're paying kind of maximum taxes. I know flippers are a bad one too.
Yeah, there's two scenarios there. So one, they're doing short-term capital gain. Number two, their lots are basically treated as inventory, and so it's ordinary income, right? In both cases, we can defer the tax bill. So in the short-term capital gain scenario, let's say they're doing 5 or less flips in a year, basically any capital gain can go into this trust. So it's short-term or long-term. So when the capital gain goes into the trust, defers the tax bill, you can take it back out and go buy your next flip. So pretty powerful tool for flippers. But you have to kind of have, you can't do that with $100,000. The trust needs to have, 500,000 or more essentially in it before you can do that.
Okay.
That's actually the minimum in the trust is 500K. For the real estate,
I know people who flip apartment complexes, same kind of scenario, right? Yeah.
Yep.
Or $1 million mansions. People can flip anything these days.
Yeah.
People are flipping businesses,
True. And all of those scenarios can work with this trust. But the other thing is, for a developer, that becomes ordinary income. So capital gains doesn't work, right? Wrong. We can actually set up the structure so that the developer can sell those lots and treat them as a gain that basically goes into the trust. Now, the details of that are fairly complex. We need to talk to the lawyer about how it works, but we've specifically done that with developers before.
Okay. So there's strategies for just about anything in there. So what about people who want to deal with legacy wealth, right? So for myself, I have a special needs child. I want to be able to leave money to him and my other son, and that's really important to me. For some people, that's not a big concern, but for me, that is. So what are some particular strategies that I might use? Say I want to sell my businesses and retire, but I still want to set my kids up for a good inheritance that hopefully they won't blow the moment I'm gone.
Yeah, right. Well, there's the whole, first off, having a living trust would be very important to, define your wishes, and you can get as specific as you want in terms of, what they can do with the money that they're inherited, right? However, this same trust that I was talking about, it has kind of two flavors. One flavor is below 10 million, one is above. The one above 10 million, you can actually take that outside of your estate and have your heirs inherit it with no tax. We also have, and basically because it's taking it out of your estate, so if somebody's got significant wealth, so let's say they've got 50 million in wealth, them and their wife together, they have 14 million each currently as the inheritance tax exemption, right? So they're clearly over it. Well, if you took the amount that was over it and you sold assets and put those into this trust, then those can be outside of the estate. So you can still hold the 28 million of other assets, not have that inheritance tax. And then in addition, you could have this other money, which is outside of your estate, also be inherited. So depending on the size and the complexity of what you've got going on, we've got different strategies. So if you're, in the 5 million range, there's a different strategy than if you're in the $50 million range, right? But basically, we could talk through those strategies.
So you just need to leave instructions within your living trust of how that is to be handled.
Exactly.
At that time. Okay. Yeah, because personally, I do a lot of real estate syndications, right? Most of them, your money's locked in there for anywhere from 3 to 10 years. Depends on what you're syndicating, what you're investing in.
Right.
But we basically have it staggered, so something, or a few somethings come due every few years, but maybe I pass and there's still 5 years of that to come. I don't know that my children would know how to then reinvest that or what to do with those proceeds. So you're saying I could build that in advance, say, hey, these are to go back into another syndication, or has to be, I guess, are there people you can trust to handle that in your absence?
Exactly. Right. So you'd have to do the executor, and then essentially within the living trust, it would define what you want to have happen. And so, for example, let's say you've got 10 million in a trust. It's outside of the estate. It's inherited by 2 children, and one of them says, "Hey, I want to cash it out." Or let's say they both say, "I want to cash it out," and the living trust says, "No, you can't cash it out until you're 40. In the meantime, you get the income." You can do stuff like that, right? And then say, okay, if you're 40 and you haven't figured life out, well, you're not going to, right? or maybe one of the children, there's somebody who's the the executors appointing somebody to be, their financial administrative person. And then you're saying that, that person cannot make more than X percentage of the income from the trust, and the trust is owned by the child can't sell the trust, but they can take the income of it for the rest of their life. And then, so you can get as complex as you want or be as flexible as you want. It's really up to you. So we've had situations where someone passed away, 2 children, they basically take the trust, they split it in half. One of them cashes it out. The other one says, I want to keep it and I want to change the interest rate to 10% because I'm young and I want to grow the trust. You can do that. It's just, it all comes down to how things, how you want things to play out.
Got it. Let's see if we have any more questions here. Peter asks, how is this trust structure called?
So the name of it. So the official name of it is a deferred sales trust. There's actually multiple companies that do this. Not all of them are actually the company that we work with. When we go look at solutions, we're looking at vetting with partners who have proven over time their track record of being able to perform what they say they're going to do. So for example, with the deferred sales trust, that company's been around 30 years. They've been audited 30 times. They've never lost to the IRS. They provide audit defense. Other companies don't. But they call it a deferred sales trust, even though it's really the guy who invented it. He has actually proprietary rights to what he does, and he protects those rights. Somebody else will call it the same thing, but they don't provide any of the protections. And so if people are basically saying, oh, you can buy an insurance policy on this, basically what they're doing is they're making money on the insurance policy and then throwing all the risk back onto you and the insurance company. And they're just, I got paid, I'm gone. That's not what you want when something's going to be around for a long time, right? So we look that the founders of the company are still there. We want to know that, like in the case of that tax deferral strategy that I talked about for doctors, the company that does that puts their own money into the same investment that you do. So they want to get their money out of it too. They've got a good track record. They've been audited. We're looking at a whole list of criteria for who we work with.
Makes sense. So I know there are some people thinking about their retirement accounts. Maybe they're already in retirement or looking to get there, right? So I have people talk to me all the time about investing through their self-directed retirement accounts. So you can maybe talk a little bit about the benefits of a self-directed versus a regular IRA or 401k. But then I also have folks that have traditional IRAs and they want to move them to Roth IRAs, but that causes a tax hit. So can you talk a little bit about first what a self-directed account is, why you might want one, and also that traditional to Roth conversion and why you'd even want to do that in the first place? Just kind of hit some of that retirement account stuff for us.
Well, one of the things I like to say is the IRA is an IOU to the IRS. What it basically says is, I'm not going to pay the tax now, but when I take it later, I'm going to pay the tax on it. So you basically, everything you're earning, eventually you have to pay the tax on it. The Roth is, you paid the tax up front, and now the money sitting in the Roth IRA is growing tax-free, and you can take distributions tax-free. You have to hold on to it for at least 5 years, be over 59 and a half, blah, blah, blah. There's a bunch of rules around it, right? But the whole idea is you're setting this money aside for the future. What you don't want to do is to basically be forced to take it when you don't want it, like with RMDs, required minimum distributions at age 73. And you don't necessarily want to have to pay potentially much higher tax bills when you're older, and you can least afford to lose that money. So a Roth conversion, what it's going to do is to say, I'm going to pay the taxes now to essentially move my money from an IRA into a Roth, and which is now not going to be taxed for its growth or its investment amount from that point forward. So it's after tax money because you paid the tax. What a Roth conversion does is it lets you take your money in an IRA and move it to a Roth. So basically you're cashing in that IOU. Now, what's interesting is, let's say you're making $250,000 a year in your business, and you've got $1 million in IRA you want to move to a Roth. Well, every year you could take $250K, move it from the IRA to the Roth and say, now I have a 500,000 income instead of 250 that I have to pay tax on. But then we can do our tax strategy that reduces your taxable income by up to 50%. And for a $100,000 investment, you would get a $250,000 tax deduction. So you'd still be paying the same taxes on 250,000 that you were originally paying anyway. But now you've got 250,000 that went into a Roth, and you've got a $100,000 investment that's paying you a return, and you get the money back in 5 years.
Wait, okay. So the key there was you had to be over that $500,000 threshold to make that work.
Right.
So you would wait until your IRA got to at least that amount to move it to have that work.
Well, yeah, and the whole thing is let's say I'm making 400,000 and I only have 100,000 in my IRA. Well, I can take the 100,000 and move it to the Roth, and then I can still get the tax deduction on 500,000.
Got it. Okay,
right?
So you're gonna deduct off the full income, not just off the part that you're moving, because I've heard other strategies for reducing the amount that you're moving over, but this reduces it off your entire income, not just that. So it can actually benefit you more than just not paying the tax on the IRA.
Yeah, exactly. And then a self-directed IRA, and there's other strategies which are more complex we can talk about that, what if you're buying, you do a self-directed IRA, you're buying an investment property, the investment property pays no income for 5 years, you bought it for 500,000 investment, into a syndication. Well, it's not worth 500,000 in the time value of money, so you can adjust that down. So we can get into that. That's a more advanced conversation. But what a self-directed IRA or a self-directed Roth IRA does is it allows you to take your money out of a Schwab or a Fidelity account and to put it into an account that allows you to go invest in almost anything you want to invest in. The key thing is you have to have a very clean paper trail where that money doesn't cross your personal bank account. Number one, and there's companies that help you do that. Number two is then now I can basically go invest in a syndication, let's say, that's paying me 8% a year instead of having it in the stock market that's going up and down and making me 6% per year, because it's a conservative investment in the stock market, right? Mm-hmm. So what it does is it creates freedom in terms of what you're investing in, and then you can start getting into investments that are actually growing your wealth faster than if you just left it in a stock account.
Right. Yeah, I talk to a lot of people that invest in stocks, and these are the two things I hear. The stock market is down, so I don't want to cash out because then I take a loss.
Yeah.
Or stocks are up, so I don't want to cash out because it might keep going up. And so I'm like, are you ever going to use this money you earned?
Or it's gone up, and I now have to pay tax on the amount that it went up by.
Right, on your gains. Either way, you're screwed, right? So I'm like.
However, there is a scenario which I do quite often where somebody's selling a stock, and let's say they had a 20% gain on the stock, and they want to take some money and put it into some investment, but they're going, I don't want to pay the tax on the capital gain. Well, what if you could do that QOZ transaction I talked about, where we just take the capital gain, we go invest it, and then the remainder is your basis, which you get put in your top pocket tax-free. So let's say I wanted to put 400,000 into something, an annuity or a syndication, whatever. So if I have 20% profit on my stock, I sell 500,000 worth of stock, I take 20% of it, put it into a QOZ, pay no tax on that, it makes it actually return, and after 10 years it doubles. Plus, then I take the remaining 400, which has no tax, and I go make that investment I wanted to. Now I just basically freed up the capital, make an investment without paying tax, and I've got two investments instead of an investment and a tax bill.
Sweet. I love it. Yeah, I've always liked the Roth more than the traditional, but of course no one told me about that until I had the traditional for a long time. So yeah. Traditional makes sense if you're going to earn nothing in your older age, I guess. But my plan is not to earn less in the future, it's to earn more. So once I got into these vehicles that make you a whole lot more money, I'm like, oh my gosh, now the tax bill is going to be really high. So it makes sense for me to convert over to the Roth and then build my wealth there tax-free. But yeah, that conversion is painful if not done correctly. So now I know there's more than one way to do that. So
yeah, exactly.
Yeah, exactly. Okay. I think we have another question here. Francisco, is your firm tax preparers or only tax strategists?
Yeah, our licensing is actually registered investment advisor. So we are not CPAs. We work with lots of CPAs. We like to work with CPAs. Some investment advisors don't. But our tax strategy firm, deferredtax.com, we basically use the strategies that we use ourselves. So my partner and I, these strategies, we found them because we use them, and then essentially decided, hey, we could make a business out of this. So that's how we kind of went into the tax strategy space.
Love that. Love that. Okay, we've got about 4 minutes left. So if anyone's sitting on questions, now's the time to hit us with those. But I've got one more here because I saw a couple of names on the people viewing here, and I know some of those are realtors. So are there tax saving ideas that they can suggest to sellers of homes that might also help them get that property sold faster?
Most definitely. And so what I like to say to keep it simple is just remember this sentence. And so you hear somebody talking, you're talking with somebody about getting a listing. You're saying, yeah, but I wish I didn't have to pay this big tax bill. If you go, well, what if you didn't have to pay the tax bill? And they'll say, what do you mean? You say, well, I've got someone on my team that I'd like to introduce you to. They can actually help you not pay the tax bill. Would you list with me then? How many more listings would that get? There's also commercial realtors who, let's say, it's always the buyer and seller not agreeing on a price. Well, what if you could tell the seller, hey, because they're figuring in, I'm going to have to pay tax on all the money I make, right? Well, what if you can get a 30% reduction in the amount of, basically you would get that tax money back to you to invest. What if you didn't have to pay the tax? Would you take a lower price on the sale?
Okay. So you got two ways to approach it. One to get the listing and one to get the price down to where you need to be. And I'm thinking maybe some that are scoffing at commissions, you might be able to use that to get over that commission hurdle too, right?
Exactly. Is my commission worth it? I just saved you 30%. My 2.5% commission is not a big deal.
Yeah, exactly. So Pierce says, love it. Thanks. Yes. I was thinking of you. Okay.
Yeah,
very good.
I just noticed, so it said deferredtax.com. To get a hold of me, it's Chris Shockowitz. So it's deferredtax.com/Chris.
/Chris. Okay. And your email is chris@deferredtax.com. Is that correct? Yep. All right. Yep. Very good. Very good. All right. Well, so deferredtax.com/Chris to find them on the website there. Very good. Very good. All right. Well, I've got no further questions. It looks like our viewers, you've just got their heads spinning to the point they can't even come up with a question right now, or they're lining up to talk to you. But I just want to thank you so much for coming on here and sharing all this valuable information with us. And I promise our listeners we're going to stay on time, so we are going to wrap it up here. But thank you again, Chris. Can't thank you enough. But I know you've helped me out, and I know you help out a lot of other people. So. Andrew sends his thanks as well. All right. Well, with that, we'll say yes, mine too. Mine is sizzling as well. So thank you so much. All right. With that, we'll say goodbye to everybody. Enjoy the rest of your day, and thanks for joining us. And we will send out this recording to you. So if you need a little more time to go through it in your head, we'll have that available for you to watch once again. All right. Jocelyn also said, great job. All right. Thanks, everybody. Have a good day. All right. Bye.
Bye.